In today's video, we're going to talking about several new retirement rules taking effect this 12-month that could meaningfully modification how much you're able to save, how much you pay for wellness are, how income is taxed, etc. Generally, and on the surface essentially, some of these changes look small, but once you see how they interact with the tax codification over time, they can shift chiliad and sometimes tens of thousands of dollars in or out of your pocket over the course of your retirement. If you're new here, hi. On top of that, I'm Sally Krawcheck, basically certified financial planner and negotiate director of IRS Advisory. We work with individual and couple approach retirement who have make a very goodness job economy, but now face a different challenge. The truth is, the rules that govern retirement have become incredibly complex. Generally, it's no longer just about how much you've saved or how much you have. It's about how that money flows through the tax brackets, healthcare subsidy, Medicare hunting charge, and other withdrawal strategy over the side-by-side 25 to 30 age. Because when these rules change even slenderly, it can totally alter your scheme, and that's just why I'm making this video. Notably so today, I'm going to walking you through the key retirement normal changes for 2026 and explain what they really mean using real-life examples. Truth is, so let's get into it. The reality is, let's start with the modification that affects the most workers right now. Retirement contribution bound. Every year, the IRS adjusts how much you can kick in to retirement accounts ilk 401ks and 403bs. Paraphrase. Let me put it this way. In 2026, the maximum contribution boundary increases to $24,500. At the end of the day, really, and that way if you're workings and participating in quite a workplace employer retirement design, you can now defer up to $24,500 of your salary into that account. Paraphrase. If you're age 50 or older, you're allowed to shuffle an additional catch-up contribution, but interestingly, in 2026, that catch-up amount is $8,000. So somebody AED 50 or older could potentially contribute sort of $32,500 into a retirement chronicle in one 12-month. Here's the deal, but there's another formula that many citizenry don't grasp exists. Clearly now, between ages 60 and 63, there's an enhanced catch-up contribution uncommitted. Paraphrase, during those years, the catch-up part can ascend as up to $11,250. When you add that to the $24,500 base limit, someone in their early 60s could potentially contribute up to $35,950 into their retirement plan in a single year. So, what's more, let me give you a model. Let's say Marker is 61 years old and plant, as a senior engineer earning $185,000 per 12-month. Mark has done a decent job saving, but he realizes that he wants to accelerate his retirement savings before he stops working at age 65. Sometimes, in 2026, Mark can chip in $24,500 as his regular pay deferral, but because he is between ages 60 and 63, he can also chip in the $11,250 enhanced catch-up. So that brings his total contribution to $35,750 for the 12-month. If Mark does this for 3 between age 60 and 63, he could chip in over $107,000 into his retirement account during that short window. And if that money grows at an average rate of 6% annually over the next 15 old age, it could potentially grow to about $250,000. And this is why those early 60s age are in reality so successful in planning for those who are a bit shy on savings. Many citizenry are earning their peak income during that period, and the tax code now allows them to speed up retirement contributions before they leave the workforce. If you're in this window, please check your part limits as many don't realize that these enhanced catch-ups exist, and bonus points if you're doing a Roth 401k. Okay, let's move on to some other rule modification that could affect early retirees in a big way, and that involves wellness policy. Now for the past various age, the Low-Cost Care Act expanded wellness insurance subsidies, which made insurance coverage much more affordable for those for many early retirees. In fact, but those expand subsidy expired at the end of 2025. Look, so now, beginning this year, the original subsidy construction returns, and under those rule, if your income surpass roughly 400% of the federal poverty level, you may lose your wellness insurance subsidy entirely. So for a married duo, that income threshold is just about $84,600. And this creates situations where income planning becomes extremely important. Here's why this matters. So let, basically, me give you a simpleton model. Alex and Amanda are both 60 age old. They recently retired and are life-off savings while waiting to claim social protection at age 67. Their financial program is designed to donjon their taxable income right around, really, $84,000 per year, so they can qualify for some ACA subsidy. With those subsidies, their health insurance premium might be about $650 per month for both of them combined. Truth is, now, imagine Alex decides to issue an extra $5,000 IRA back down 112-month to pay for a kitchen renovation. Let me put it this way, that extra back down pushed their income to $89,000 for the year. At the end of the day, actually, and because they track the subsidy lineman, they could lose their ACA subsidy entirely. Honestly, so that premium might suddenly increase from $650 a month to $2,000 a calendar month. And that's a difference of almost $17,000 a year, triggered by a relatively small increase in non-exempt income. Actually, and this is why managing your non-exempt income between age 55 and 65 has get one of the most important planning windows in retirement. But here's what's interesting. Healthcare subsidies are now tied directly to income, which means that withdrawals, Roth conversions, capital gains, social protection timing, all of that good stuff get portion of the same planning conversation. If you're planning to retire before Medicare get down, make sure that you cautiously run the numbers so that you realize how income decisions now impact your insurance premiums later. Now, this is easier in some states than others. Naturally, so let's go back to healthcare for a second. Look, what's more, this time we're talking about after age 65 when Medicare began. Medicare costs continue to rise gradually each 12-month, and in 2026, the Criterion Medicare Part B insurance premium is $22.90 a calendar month with an annual deductible of $283. At number one glance, those numbers may not seem that considerable, but over the class of a long retirement, they add up in really meaningful ways. Look, consider Bob and Linda, both at age 67, who are inscribed in Criterion Medicare Portion B and also carry a Medicare supplement policy. Here's why this matters. For Part B loan, they each pay $22.90 per month, which means together they pay about $405 per calendar month in premiums. Generally, over the line of a 12-month, that come to approximately $48-$60. Now stretch that over a 20-year retirement, and they'll spend close to $100,000 just on Medicare Portion B premiums alone. And that doesn't even include their supplemental policy, ethical drug dose design, or any potential IRMA charge. Besides, IRMA, which stands for Income-Related Monthly Adjust Sum, is an extra Medicare hunt complaint that utilized when retirees report higher levels of income. And many people don't realize that it applies to both Medicare Portion B and the Portion D ethical drug insurance coverage. The reality is, interestingly, these hunting charges are based on your modified, adjusted gross income reported on your tax return from 2 age prior. Obviously, so for example, your 2026 Medicare premiums are based on the income shown on your 2024 tax return. So if Bob and Linda's income rises above certain thresholds because of large IRA backdown, working capital addition, Roth transition, their Portion B insurance premium could addition from $22 a month to over $600 a calendar month. Notably, and on top of that, they would also pay an extra monthly hunt charge for the Medicare Part D prescription dose coverage. So in other language, higher income can trigger 2 separate Medicare surge charges at the same clip. To be honest now, let's get more specific. Imagine Bob and Linda carefully plan their climb down in their income for the year, and it comes in at $211,950. They stay under the Medicare threshold and pay the Criterion insurance premium. Now, ideate they take just one more small IRA withdrawal of $100 for something, right? A dry cleaning, whatever. Their income now is $212.50, which is only $100 over the limit. Naturally, because IRMA works like a cliff rather than a gradual phase, and that small increase pushes them into the following bracket. Truth is, so instead of paying $22.90 a month for Part B, their insurance premium jumps to about $35 each month. That means that their Unite Part B insurance premium ascent from $405 per month to $69 a calendar month. Plus, and on top of that, IRMA too apply to Medicare Part D prescription dose insurance coverage. So they would pay an additional insurance premium of about $35 per month there as well. Here's why this matters. No doubt, suddenly their some Medicare premiums jump from, you cognize, $4,800 a year to closer to $78,000 a year just because their income crossed a line by $100, right? Frankly, that is, you cognize essentially $3,000 more per 12-month, triggered by $100 more of an IRA withdrawal. Here's the deal. In retirement, income planning does not just impact your taxes, it affects your health or cost as well. So negotiate withdrawals, conversions. At the end of the day, additionally, investment income thoughtfully can help Donjon Medicare premium under control over time. So if you're approaching Medicare age or already enrolled, it's worth reviewing how your retirement income scheme influences your Medicare premiums in the old age ahead. Now, if you need help crafting your income strategy, click the first link in the description below to ticker my free training picture on exactly how we approach this window to optimize your own retirement. Really? Okay, so now let's look at some positives happening on the tax side. In 2026, the standard deduction for married couples filing conjointly is $32,200. If both spouses are age 65 or aged, they each get an additional $1,650, bringing the sum standard deduction to $35,500 and, paraphrase, naturally, but there's some new benefit layered on top of that. Definitely, under the new tax law, seniors age 65 and elderly can too claim an extra $6,000 discount per someone, which means that a married duet could potentially deduct some other $12,000 from their taxable income. This new elder discount is available from 2025 to 2028 and begins phasing out once income exceeds $75,000 for individuals or $150,000 for married duet filing jointly. That means that a married couple over 65 could potentially reduce their non-exempt income by as much as $47,500 before Eve, considering other strategies. Here's the deal. That means many retirees can have a meaningful amount of income coming in before they owe much in federal income tax. So, for example, let's say Tom and Kelly are both 67 age old. Of course, they receive essentially $1,000 per 12 month from sociable protection and withdraw $24,000 from their traditional IRA. So they're living on $76,000 of total cash flow. Importantly now, even though that sounds like a solid retirement income, not all of it's taxed the same way because Social Security is actually only partially taxable. Only $11,100 of their social protection welfare would be included in taxable income. And when you add their $24,000 IRA withdrawal, their sum income for federal tax purposes is $35,100. Think about it this way. So, after subtracting their $35,500 standard deduction and the new senior discount of $6,000 each, they're left with, essentially negative taxable income. Actually, in other words, their life on $76,000, but none of it's exposed to tax. Now, let's say that they have a long-term working capital gain of $20,000 that same 12-month, and they'd ilk to harvest to reset their cost basis. Of course, they can do that basically, pay $0 on the long-term working capital profit itself, and owe less than $500 in tax on ordinary income. This is why retirement tax planning matters so much. The mix of where you pull income from can make a huge difference in how much tax you really pay. Now, if you approach retirement, this is a good reminder to face beyond just your account balance and to outset thinking about how your withdrawals will be structured year by year. Okay, here's the bottom line. Now, let's talk about charitable gift rules because they're also modified somewhat in 2026. If they take the measured deduction, one positive update is that taxpayers who don't itemize deductions can now deduct charitable contributions of up to $2,000 for conjoined twosome, which allow more households to obtain a tax benefit from their gift evening. Actually, for retirees who do itemize that state, there's a new rule where the number 0.5% of charitable contribution may not be deductible, which slightly reduces the tax benefit for some donors. Obviously, that said, one strategy that continues to be highly powerful for retirees is something called a qualified charitable distribution, or a QCD. Really, a QCD allows somebody age 70 and a half or older to donate money direct from their IRA to the qualified charity. Truth is, the amount donated counts toward their required minimum distribution, fundamentally, but it does not show up as taxable income on their income tax return. Also in 2026, the maximum QCD amount increases to $111,000 per person. The reality is, of course, let me spring you a simple instance. Clearly, Dorothy is 74 years old and has a $1.6 million traditional IRA, which gives her a required lower limit distribution of about $58,000 for the year. Here's the bottom line. Generally, Dorothy typically donates $20,000 every year to respective charities she supports. So rather of withdrawing the full $58,000 and then writing checks to those charities, she instructs her IRA custodian to send $20,000 directly to the organizations as a qualified charitable dispersion. That $20,000 satisfies part of her postulate minimum dispersion, but it's not taxable on her tax return, right? Frankly, so as a result, her non-exempt income may drop significantly, which can reduce her federal taxes, potentially lower Medicare charges, and even reduce how much of her social protection benefits are non-exempt. To be honest, for a retiree who already designed to support charitable causes, a qualified charitable distribution is often one of the most tax-efficient slipway to give. Okay, now that you've seen how several retirement normal are changing in 2026, you can get go to understand how these updates affect the bigger picture of retirement planning. At the end of the day, besides donation boundary, healthcare subsidy, Medicare premium, tax deductions, and charitable giving rule all interact with each other. Paraphrase: truth is, an even small alteration in the system can have a meaningful impact on how much of your money you actually keep with time. True, and even small alteration in the system can have a meaningful impact on how much of your money you actually keep with time. If you need help understanding how these normal apply to your own retirement program, click the tie below to watch my loose preparation where I walk through how to structure retirement income so that you can reduce your taxes, manage your health or costs, and shuffle the most of your savings you've worked so hard to build.